Good evening, everyone. Welcome to our Irvine Homebuyer Workshop. My name is Jason Made. I'll be your facilitator this evening for tonight's class. Really excited to be able to join you guys with this content. We get a chance to teach these classes every quarter with our UCI partnership. Really excited about that. We're going on probably our fifth year now with our partnership with UCI. So really appreciate you taking some time out to be able to kind of hang out with us this evening. Tonight's class will run just about an hour. How we try to make these classes is very interactive. So as I move through tonight's slides, we'd encourage you to be able to get connected with us through like the Q&A or chat, and I'll be able to answer some of those questions on air for you. So we really want to kind of have a little bit of interaction here with our guests tonight. So really our goal with tonight's class is we want to kind of inform you more about what home ownership could look like for you. So whether this is a goal for you in this year in 2023, or you're just kind of planning for the future, we want to help kind of provide you more resources and support to help you on your path towards homeownership. As I mentioned earlier, we've been in partnership with UCI alumni for the last several years. We're really fortunate to be able to bring, I think, this helpful content to first-time buyers as they start on that path towards homeownership. And, in bringing this information to you, we do host classes just like this every quarter. So, if you enjoy what you're hearing tonight, want to encourage a friend, family, or maybe even a coworker to come check out one of our events, we'll be sharing with you some of our upcoming schedule events later on in tonight's call. Just a little bit about me. So I'm a branch manager with American Pacific Mortgage. American Pacific Mortgage is one of the top 10 lenders in the country. And our particular office focuses a little bit differently on kind of education, as kind of, helping provide first-time home buyers, really the tools and resources they need to make a good decision with their upcoming home purchase. So like I said, we're doing these classes to help really provide that value to our local communities. Now, we specialize more so in first-time buyer programs. So as we work across California and other states, we kind of really focus on looking at different first-time buyer programs that are available, but we do a wide range of programs, which you'll learn a little bit more later on tonight. Let's talk a little bit about our talking points for this evening. So we're going to look at the housing market today. We'll spend some time talking about interest rates. We'll look at the kind of the home values, what's going on. I mean, there's a lot of information to share with you. We'll talk a little bit about budgeting. How do we make sure we're on track? And maybe, really what's our side-by-side comparison of renting versus buying? What's that going to look like for us as that relates to budget? Talk about credit. We'll spend some time looking at just budgeting for student loans and how those kind of factor into financing. Talk about loan programs, some of the qualifying documents that we'll need for our setup of our financing. We'll look at assistance programs that are sponsored here in the state of California. And then we'll kind of wrap up tonight's discussion looking at the loan process. So if I'm kind of interested in what I'm hearing tonight, what's that going to look like for me to get started on that path towards homeownership, to go from like pre-approval all the way to the very end of the stages where you get like keys to your house. And then I want to spend some time sharing with you a little bit more about what a consultation looks like. Okay. As I mentioned earlier, when I kicked off our class tonight, really encouraged kind of an interaction as we go through tonight's discussion. So feel free to, just put your question in the chat and I'll answer those on air as best as I can. So let's first talk a little bit about buying, and, does it make sense for me? Because this is probably going to be one of the biggest purchases you make in your upcoming financial future. So taking time out on a busy Wednesday night to hang out with, this mortgage guy to learn more about home ownership is not probably the ideal Wednesday night. But at the same time, you're making those investments and kind of just learning a little bit more on what home ownership can be for you. And when we think about home ownership, not only is it going to be the biggest upcoming investment we make, but there's a lot of benefits that come along with that. The benefits of owning a home include stability in your housing payment. So I don't have to worry about my rent being jumped up another 3 or 4% when I renew my lease. I have the opportunity to be able to create wealth through the growth and equity in my home. I have the ability to take that asset, sell it maybe one day, or maybe perhaps pass that along to the heirs of my estate. And there still is some great tax benefits that come along with owning a home. So when we think about budgeting for a home, it's not necessarily like an apples to apples comparison, because there's so many great kind of investments that come out of, or value adds that come out of owning a home. So what I want to start off tonight's class doing is kind of taking a look at a budget and what that could be. So we're gonna do a comparison when we look at renting and going down the path of rental situation for the next 7 years. What could that look like if we compare that to home ownership? So we're going to take you through this kind of helpful tool, which is a rent versus buy calculator that's brought to us by Freddie Mac. So I'm going to just screen share with you guys this calculator so we can kind of talk through it. And in case I didn't mention to you earlier, all of our material that I share with you this evening, we're going to go ahead and send to you in email tomorrow. So you'll get a copy of all of our presentation. All the links that I share with you tonight will be provided to you via email. So let's kind of dive in and look at this calculator and kind of talk through maybe a real life example for us when it comes to budgeting. So what we're going to do is we're going to kind of plug in some numbers. We're going to start from the top here. We're going to first set up as, what does our rent look like? So I know everybody's housing situation is different depending on where you're joining us in the state, whether you're in Orange County, you're in the Bay Area, Sacramento, the Central Valley, LA County, whatever that might be. I know everybody has different housing expenses, but we're just going to kind of create just a what if scenario in tonight's class. So let's say we have monthly rent at $2,500 a month. We're going to assume monthly renter's insurance of $15 a month. We have an assumption around rental increase. So when I renew my lease every 12 months, let's say, that rent's going to jump up about 3%. And then we'll look at the home price. So we're going to assume, and I'm going to make a little bit of adjustments here. Actually, we'll leave it there. We'll leave it at 500,000. Whoops, not 1.98 million. That wouldn't be quite the first time home buyers home. So let's leave it 500,000. The minimum down payment is 3% as a first-time buyer. We're going to talk a little bit more about programs in just a bit. Property taxes, we generally estimate property taxes just right around 1.25% of your purchase price. Now, if you're doing some searches on Zillow or Redfin and you're trying to do some payment calculations, those numbers might look a little bit different in some of those calculators. We're going to talk about our mobile calculator or APM mobile calculator in just a bit. But, generally the rule of thumb is 1.25% of the purchase price. We have homeowners insurance. We're going to factor in $1,000 a year, maintenance cost at $1,000 a year. And then when we look at loan information, generally most first-time buyers are going to elect a 30-year fixed mortgage. And with today's interest rates, we're gonna spend some time talking about that in just a bit. Interest rates are kind of coming down just a little bit. We'll tell you why in just a minute. But let's put an average interest rate. We're gonna push that up a little bit to like 6.625%. Origination charges, that's going to be what your lender charges you for your financing. With working with our APM team, one of the cool things that we provide in our value to our partnership with UCI is there's a discounted closing cost program. So not only going to get all the great benefits and resources that we provide, but you get $750 off of your closing costs with APM. Discount points, which we're going to spend some talking about in just a minute around interest rates, but let me kind of just share with you what discount points are. That's when you as a buyer have the opportunity to bring down the cost of your interest rate by paying additional costs out in the form of closing costs. So let's say I have a rate of 6.625%, but I really want to get a rate closer to 6.375. I could pay additional costs to help bring down that rate called points. And usually 1 point is the equivalent of 1% of my loan amount. And so that's where we'll get that 0.25% reduction in rate. It usually takes about 3 to 4 years for a buyer to break even on those investment and costs. So in this market right now, I don't necessarily recommend, buying down interest rates unless we really have to get that payment down a lot lower to be able to make that feel affordable for us. Other settlement services are going to be things like title, escrow charges, maybe transfer taxes for the local county that we're going to buy in. And then we have other assumptions. So in this scenario, we're going to assume an appreciation rate of 3% on my home, that I'm going to be in that house for 7 years. So when I show you the side-by-side comparison, we're saying renting for 7 years versus buying for 7 years. Selling costs of my home. Now, just so you know, when you are represented by a buyer's agent as a buyer, you don't pay the commissions that those agents earn for the sale of that home. Those are all paid for by the seller. But when we turn around and sell our home in 7 years from now, we will be responsible for paying those commissions to the buyer's agent and sales agent whenever we sell that home and to whatever parties are involved in that sale. We have state and federal taxes, and then we have the savings rate, which of course probably savings rate's a little bit higher than what we have estimated here. But let's first of all look at the difference in payments. So I think that's what we got to prepare ourselves for as future home buyers. We know our rent's about $2,500, but the mortgage payment's $4,200. So we're jumping up quite a bit. Yes, interest rates have a role in that. Obviously, the cost of home prices are playing a role in it. So all those are all kind of big factors. But I think when we design our budget for home financing, we got to look at potentially the upside of owning a home, because when I think about my increase in expenses, yes, those are going to rise, but I do have the opportunity to create, future wealth by buying instead of renting. And in this example, it's $34,000 to the side of buying versus renting, which shows that opportunity, because how I get there is through the appreciation of my home, my potential tax benefits that come out of owning my home over the course of 7 years. So when we think about our path towards home ownership, it's not necessarily going to be that, hey, I'm renting for $2,500. I really got to buy my home at $2,500 a month. That may be the mindset, but we got to think about all the other value-added items that come along with owning a home. Okay. So that's our financial calculator or mortgage rent versus buying calculator. Let me get us back into our slideshow, and we'll continue on. So let's talk about the housing market now. So we're going to shift gears from budgeting. Now let's look at the housing market. I think there's a lot to be seen in the market. And so when we look at, and this is just a kind of a snapshot of the Irvine market. So you may be joining us from Riverside or San Bernardino County. And I think those markets, while the price is a lot lower in those markets, the kind of the inner workings of the markets look very similar, which is we have really the lack of inventory on the market. So there's not as many options to choose from in the market. Why is that occurring? Well, let's think about it. In 2020, 2021, we saw historic lows in interest rates. So a lot of existing homeowners refinanced to 2.5%, 3% rates. And not all of those owners are willing to give up those rates, sell, cash out equity, move on to the next house, and maybe exchange that 2.5% rate for 6.6 or 6.5, whatever the rate may be. So I think there's a little bit of a kind of a challenge there in the market right now. So unless sellers are moving out of state, they have a relocation, they have to sell because they just need to cash out equity, maybe they're retiring, whatever the case may be, there really isn't that demand to sell. Now, that'll probably change as interest rates start to flex a little bit. We're seeing some buyers start to shift gears and maybe not go the resale market, maybe look at more new homes. And so that's certainly an option as well. But I think that's kind of what we're seeing as trends in the market right now. Not a lot of inventory, not sellers willing to come to the market. And so, we'll see how that kind of plays itself out. Historically, we're in the busy times of the year, the summer, spring, summer buying months. We're not seeing as many choices, though, for our buyers as it relates to, inventory out in the market. So that's one of the things that's kind of going on right now. And I think that will improve over time, but at least in the now, buyers don't have as many choices. Now, interest rates, as I mentioned, are driving a little bit of the behaviors in the market as it relates to sellers, but I think buyers having a little bit of challenges there as well, because interest rates are going to influence that budget that we just talked about. Interest rates right now on average are, right around 6.8. A couple of weeks ago, we did see interest rates crest over 7%. Obviously, that creates a little bit of, challenge or panic in the markets, but now we saw rates start to kind of come back down a little bit. What's driving interest rates right now? Well, the Federal Reserve monetary policy is to control inflation. And so because of, where inflation's at right now, we've seen the federal funds rate, rise consistently over the last couple of years. In fact, the federal funds rate is about 5.5% as of today, the highest it's been in 20 plus years. And why is that? Well, that's the Fed's kind of tool to help control inflation. And we'll have to see kind of where, that Federal Reserve rate goes from here. The markets kind of moved a little bit today based upon Chairman Powell's remarks at the Federal Reserve meeting minutes. And so we'll see kind of where markets go from here. I think we've probably, tipped out in terms of where interest rates are at. So we saw us go beyond 7% a couple of weeks ago. We're back into that 6.8 level. I don't think we're going any higher from my perspective. I think the question is like, how low will we go in the next 6 months to 12 months? Because that's ultimately going to affect some of the buyer activity. But I think, the perspective or the mindset has kind of shifted a little bit. I think now buyers understand that, of course, the 3.5% interest rate days are no longer here. We won't probably ever see those come back. So we've kind of had to reset expectations. So as we design home buying plans for our clients, there are going to be those rates in the sixes, and trying to figure out what our purchasing power and affordability looks like at those newer interest rates. Now, interest rates are not all the same for every buyer. So that's important to understand, because there's different kind of ingredients that go into an interest rate. Now, that could be credit eligibility. So whatever my credit score is, generally, if you have a 740 score or better, you're going to have the best available interest rates available to you. Loan products, how much you decide to finance, what your down payment is. We talked earlier about discount points. So if I'm going to decide to buy down my interest rate, that can help influence my interest rate. And then the final thing is the term of the loan. So you have a 30-year fixed mortgage, which is generally the standard mortgage product. But if you elect to take a slightly lower term of your loan, maybe a 20-year, 15-year loan, at times those interest rates can be slightly lower. But it's really our job is that as we meet with you for a one-on-one consultation, we want to design some options for you that make the most sense, right? And I think to maximize affordability, generally the 30-year fixed mortgage product seems to be the best solution. We do get commentary from clients that, maybe they want to look at an adjustable rate product, and that can certainly be an option. But what's happening right now in the interest rate market is we have an inverted yield curve that's happening right now. So short-term rates are intersecting long-term rates. So really adjustable rates don't make a lot of sense in today's market. And especially as first-time buyers, we really want to have a more predictable and kind of sustainable, rate program for you. So we don't want to have to worry about volatility down the road. Now, one of the major things that kind of comes into selecting our interest rate is credit, right? And where we're at from a credit perspective. What's great about all the different tools and resources that are available online to our clients is we can really have up-to-the-minute information on our credit score, whether you're using Credit Karma, some of the tools offered through Experian, Equifax, or TransUnion. All that stuff's really great. And so as we meet with clients, generally, the buyer does understand somewhat of where their credit score is, but there is 3 different models to credit scoring. So there's the auto model, there's mortgage, which of course we're going to use for home financing. And then finally, there's the credit card model. So when you're looking at Credit Karma, or maybe you're on your American Express app and you're looking at what your credit score is up to date with Amex, those are going to be based upon a credit score or credit card score versus the mortgage score that we're going to use for home financing. So just something to keep in mind, that as you're looking at, where you think your credit score is, there may be some variance between what your score comes up to what you have on your side versus what we have. Now, every loan program has different credit score requirements or minimums. So FHA loans have a minimum score of 580, conventional 620. For VA loans for our veterans that have the eligibility, it's a 620 minimum. And for the CalHFA first-time home buyer programs, it's usually a 640 score for FHA loans and 680 for a conventional loan. Now, I want to take you through the FICO score kind of weighting, if you will, and how FICO score is made up. Because I think it's important to understand when you think about areas of opportunity for your credit score, kind of how is the score built? So if we look off to the slide over here and look at the weighting of the score, 15% of that's going to be how long I've had credit. So the more mature my credit file is, the better my score could potentially be. 20% is going to be how much new credit am I trying to access. Also, hard inquiries are going to be impacting this area of your score. Now, one of the things in our process we start with is a soft credit score, which a soft score gives us visibility to one of the agency scores like Equifax. And we can determine pre-approval and eligibility of products based upon that. But we want to try to avoid hard inquiries because that can negatively impact your score. There are credit rules in place that allow you to apply with, let's say in the mortgage industry, as many lenders as you want in a 30-day window of time. And that day one hard inquiry starts here. You have 30 days from day one to apply with as many lenders as you want. And that's the equivalent of one score hit or one credit score hit for you. So those are rules in place for both mortgage and the auto industry. Now, 30% is going to be, and this is probably the biggest area of opportunity for most clients, is around credit utilization. And what we're looking at here is your credit limits versus your credit balances. So if I have a $10,000 credit limit and $5,000 in credit balances, I'm at 50% utilization. I really want to try to get below 50% is kind of my starting place. If I'm really trying to optimize credit score, I want to try to get that below 10% or basically below $1,000. And finally, payment history is kind of the one that obviously makes sense, right? So the better on-time payment history I have, the more improved my credit score is going to be. Now, if I've had some challenges in the past, usually those ratings are going to be as 30-day lates, 60-day lates, and 90+ delinquency dates. Okay, so something just to keep in mind. Now, usually when you have past challenges, in the most recent 12 to 24 months is where I'm going to see the most impact to my credit score. Now, I want to take a step back and talk about utilization of credit. So if you're looking to try to manage better your utilization, as I mentioned earlier, try to at least get below 50% utilization. Optimal is below 10%. But let me give you a quick tip on how to better utilize or manage utilization. So if you take a look at your credit, one of your credit cards tonight, there's going to generally be a due date and there's a billing cycle date. So your billing cycle date is the date at which the credit card issuer sends out the data to the agencies and says, hey, Jason had a $5,000 balance. He's at 50% utilization and he's paid his payment on time. Okay, great. The problem with that is that $5,000 balance is now showing my utilization higher at 50% utilization, even though I'm going to pay that $5,000 balance off on my due date on the 5th. So as kind of a way of managing your credit card debt, if you can try to pay down or maybe bring down that balance as low as possible for the end of your billing cycle date, then you're going to have a much improved credit score. So that's just a way of kind of maneuvering through your credit cards a little bit better, especially as you're preparing to qualify for financing. Account closure can come up as one of those kind of gotchas for clients where if you close out a card and because you did a balance transfer, all the great history that you've had on that previous card will be kind of taken out of the credit modeling. So it could actually negatively impact your score. So you want to be careful closing accounts because you could see some kind of downturn in your credit score. And when we look at financing options for clients, we always look at the middle score of all three agencies. So let me give you an example. So if my highest score is 760, my middle score is 740, and then my lowest score is 720, the middle score is what we'll take for qualifying. So that'll be a 740. Now, if I'm going to add my partner to the application, but my partner has slightly lower scores, so my partner's at 720, 700, and 680, the 700 score is what we're going to use for qualifying. And why that's important, because that 700 score being below what I'm at is going to impact the interest rate offering, could impact the mortgage insurance. So those are all things that we want to take into consideration when we're trying to design a home buying plan for our clients. Okay, we're going to move on from the credit section of tonight's class, but I want to just kind of throw it out to the group. Do we have any questions around credit that I can help answer? Again, feel free to use the chat. If you have a question, you can put in the chat and we'll make sure to answer those on air. I'm going to continue on just to kind of a quick wrap up on credit. I wanted to provide you guys with a matrix as it relates to kind of negative items, how long they could potentially be on your credit report. I think the bigger thing for most of our clients is how long our inquiry is going to be with me. So they'll be on there for 2 years or less. Really, the inquiries in the last 6 to 12 months are going to be the most impactful to our credit score. Now, there are some rules coming out. I thought they would be out by now, which will allow medical collections to be removed from the credit file. So if you have had some past challenges as it relates to medical collections, there should be some updated reporting that are going to have those removed from the credit reports. Okay. Now, we're going to kind of stay with credit to a certain extent because we're going to talk about student loans because student loans are going to come up in the conversation when it comes to designing our home buying plan for clients. Student loans, I think most of the federal student loans are coming back due again in September. So we're just right around the corner from that occurring. But when it comes to looking at your financing, we do have to factor in minimum payments when it comes to qualifying. So we want to share with you a little bit about what that looks like. If you're on an income-based repayment and that was set up prior to the pandemic, we can use that payment for qualifying. Now, if you graduated in 2021 and that was right in the middle of the pandemic, you probably don't have payments set up yet. So with the upcoming payments due in September, you may want to get an income-based repayment set up. Otherwise, there's different formulas that we use to figure out what your payment will be for qualifying. So we kind of provided that on the screen here. So on an FHA loan, which we're going to talk about in just a minute, an FHA loan requires us basically to use 0.5% of your outstanding student loan balances as the monthly payment. So like in the scenario we have on screen, if I have a $75,000 aggregate balance in my student loans, FHA is going to say, okay, that's a $375 monthly payment that we would use for qualifying purposes. Now, if I have a conventional loan, which you're going to learn about the characteristics of that, then we take 1% of the outstanding balance. So in that scenario, $750 would be the monthly payment I would use for a conventional loan. So the income-based repayment generally is going to be the lowest option. So that's why we kind of encourage clients to possibly get set up for that. There's also graduated options. I know the servicers will provide different scenarios for you to take a look at. Now, if you're back in school and you're just on deferment, that's a little bit different. We still, even though you're still in school, there's no payments required, we still have to count a minimum payment for your qualifying. So either that 0.5% or the 1%. So the forbearance has been great. It's been great for the last 2.5, 3 years. But now since these loans are coming due, we really want to make sure that, our clients obviously understand how that could potentially impact, the overall financial picture for them in qualifying. So when we look at loan programs, loan programs are going to be some of the different solutions that we think about for our home financing. And we've included 5 of the core programs that we look at for home financing. There's a plethora of different programs available, but tonight's class, we want to spend some time looking at the 5 core programs. I'll walk you through a little bit of the characteristics of those, and then we'll kind of boil it down to maybe 2 of the core products or the key products that most of our first-time buyers elect, which are usually a conventional loan or an FHA loan. I want to share with some more information around that. So let's first talk about conventional loans. So a conventional loan has a minimum down payment of 3% if I'm going to finance up to $726,200. Now, when I decide to go above that loan amount, now we go into a space called high balance loans. And that has a minimum down payment of 5% all the way up to a loan amount of $1,089,300. And that space is for our high cost of living areas. So if you're in Orange County, LA County, guess what? High cost of living area. If you're joining us from San Francisco, San Mateo, Santa Clara County, all of those high cost of living areas. So what that means is that based upon the cost of living in those areas, there's slightly higher loan amounts that we can elect as a buyer, but it does come with it a higher requirement for minimum down payment. So just to kind of recap, the minimum down payment is 3% up to a loan amount of $726,200. Once I decide I need to finance more than that, then the minimum down payment jumps to 5%. Okay. So when we think about conventional loans, Fannie Mae, Freddie Mac, that's going to be all under the conventional loans. Those are about 60% of all originations across the country. Okay. And the minimum credit score for a conventional loan is 620. FHA loans are going to be the next loan product set we'll talk about, which is a minimum down payment of 3.5%. A little bit different scenario in terms of the minimum down payment on those higher loan amounts. So we can go to $1,089,300. The minimum down payment still remains at 3.5%. FHA loans have a little more leniency around underwriting guidelines as compared to the conventional product. Minimum score of 580. We're going to talk more about mortgage insurance in just a bit because we're going to side-by-side comparison the conventional and FHA product. But FHA, when we think about that, not necessarily just for first-time buyers, can be for second and third-time buyers. But you'll see the cost structure around FHA looks a little bit different than a conventional loan. And then our VA loans are going to be for our veterans that have served, minimum credit score of 620. Generally, the veteran will have a certificate of eligibility for their service years, and then that certificate of eligibility shows qualifications for the VA product. One of the cool things about VA is it's a 0% down product. Some cases, the veteran will not even have to pay a funding fee, which lowers the expense. And you're going to learn about mortgage insurance in just a second, but VA loans, when you put less than 20% down, there is no mortgage insurance for the veteran to make that much more affordable housing option for them. So really cool product for our veterans. And then USDA loans is for our kind of more of our rural areas. So if we think about maybe some of our desert communities, let's say Joshua Tree, I really want to buy in Joshua Tree, that would be considered a rural area. And there's a couple different designations that area has to have. One, it has to meet like the rural consideration, but it also has some requirements around minimum or maximum income for the family that's going to purchase in those areas. But one of the nice things about USDA, it's a 0% down option. If you're interested in that product, there's a geocoding website that gives us a list of kind of all the different areas by geography of where they're located, and then what the income limits are by those areas. And then finally, the jumbo loans are going to be for our clients that looking to purchase a little bit more of a home. We see this a little bit more so in our high cost of living areas. So if you're looking to finance more than $1,089,300, that's where the jumbo loan can come in. But the down payment requirements start to elevate a bit. So it's no longer the 3 or 5% down payment. Now we're looking at 10, 15, maybe even 20% down on the jumbo loan. Jumbo loans are going to carry also with it a little bit more around asset requirements. So not only do I have to save up my down payment, we have to save up closing costs, which we'll talk about in just a bit, but I also need to have reserves set aside for that program. And what reserves are, it's additional assets that I have left behind once I've contributed my down payment and closing costs. Generally, reserves are going to be 12 months equivalent of my monthly mortgage payment. So if I have a $7,000 mortgage payment, and my reserve requirement is 12 months, that means I have to have $84,000 roughly in assets, in 401ks, maybe in a brokerage account, whatever the case may be. I just have to have access to that amount of funds. Okay. All right, so we talked a little bit about loan programs, but I want to kind of just spotlight two programs, which would be conventional and FHA. And I want to spend some time looking at PMI. So you hear PMI talked about quite a bit. And I think I want to kind of share with you what that looks like for you and how that impacts our purchasing power. So let's talk about conventional loans first. And conventional mortgage insurance has different payment options. So it's not just a one size fits all. So the options look like this. You can pay for PMI monthly. You can split the MI up. So you pay some of it upfront, maybe some of it on a monthly basis. You can take and you can basically pay it all out up front. You want to write a check for PMI, you can do that. And then the final option is lender paid mortgage insurance. And what that means is you're taking a slightly higher interest rate to buy out the mortgage insurance. Not really a popular option with our clients. The number one option really is monthly MI. And the reason for that is because monthly MI has a potential cancellation option. So generally, when you have 2 years in your home and 22% equity, you can apply with your mortgage servicer to potentially cancel your mortgage insurance. That's kind of a big deal. Now, mortgage insurance on conventional is not the same for every buyer. So as I mentioned, I think a little bit earlier, it's going to be based upon your down payment. It's going to be based upon your credit score and then how much you decide to finance. So that will change the premium. I kind of shared this with a client earlier. You think about mortgage insurance on a conventional loan, it's kind of like car insurance, right? So the more expensive a car you have, the high theft area maybe that you might be in, the more expensive your car insurance is going to be. PMI works very similarly where, lesser down payment, higher risk, lower credit score, higher risk. Those will all add into a higher PMI. So, it's our job really as we consult with you to help kind of get you in the best possible position, not only from a product perspective, but even all the other ingredients like mortgage insurance to help with that affordability. So here's an example of PMI and what it looks like. So if we bought like a $700,000 house, we put 3% down, we got a 740 credit score. PMI is about $209 a month for a conventional loan. Okay, so not bad. When you look at Redfin or Zillow, you're maybe doing some payment calculations. A lot of those MI calculators are not correct because they don't have all these kind of factors into them as well. So we'd encourage you to hop on our APM mobile app. That is going to give you a much truer payment indication. And then FHA mortgage insurance is where we're going to kind of draw a little bit of differentiation here, right? So FHA mortgage insurance has two components to mortgage insurance. There's monthly mortgage insurance. There's upfront mortgage insurance. So the monthly is 0.55% of your loan amount. The upfront is 1.75% of your loan amount. And that's important to understand because whether I have a 640 credit score or I'm an 840 credit score, the mortgage insurance levels don't change on FHA. Also with FHA, there is no cancellation option. So once I reach that 22% equity or 20% equity, I can't cancel the mortgage insurance. I would have to basically probably refinance into a different product, like maybe a conventional loan to exit my mortgage insurance. Now, FHA made some changes a couple months ago to bring down the cost of mortgage insurance. So it makes it a lot more comparable from a monthly perspective to conventional. So if you look at that same scenario, we have the $700,000 loan amount. We take, and add the upfront mortgage insurance, the 1.75, that's $12,000 upfront. That's a one-time cost that gets added into our amount finance. And then the mortgage insurance on a monthly basis is about $320 a month. So a little bit closer in comparison to the conventional loan. Prior to those adjustments that FHA made, we saw, $200 to $300 variance between conventional and FHA. So definitely some big improvements. Now you might step back for a second and you say, Jason, why would I ever consider FHA? Because I can see the difference in the expenses. Seems like it's a lot more than conventional. It doesn't have all the cancellation options. And you're probably right. But FHA is going to have different guidelines than conventional, different, credit score requirements. It'll have a little more leniency when it comes to maybe some past challenges. If I had a late payment on my student loan because I totally forgot and it gave me a 60-day late, FHA might be okay with that, where conventional might not be able to approve that. Or if I've had a bankruptcy, or maybe I lost a home to foreclosure, those timelines will look different for FHA. It'll be shorter time periods than it would be for the conventional Fannie Mae, Freddie Mac product. So as we meet with our clients, figuring out what product suits them best, obviously we're going to take all those different financial things into consideration. Now, we're going to talk about documentation now for building our home buying plan. I want to kind of just roll through this relatively quickly, just to kind of share with you what you should expect to prepare as you get on that path towards homeownership with regards to documentation when it comes to income. So if I'm working for a W-2 employer, generally I'm going to need the last 2 years of W-2s, last 30 days of pay stubs. We always go through a verification process for our buyers. So that's part of that processing of your loan. If I'm self-employed, I'm definitely going to need the last 2 years of taxes, because I do have to show that I've been in business for at least 2 years, profit and loss statement, and then we'll have to verify the business, usually through online records or maybe even through like a CPA letter. Those are all kind of viable tools that we can use to verify the business. Now, I always like to take some time out during our class to kind of dispel some myths, if you will, when it comes to taking those paths towards homeownership and, having buyers that have a lack of employment history. Because we have a lot of, new graduates through our programs that are looking to just start their careers or maybe even haven't graduated yet. And so the rules around employment history look like this. So I don't necessarily have to have 2 years on the job. I just have to have 2 years of work and or educational history. So if I graduated in the spring from UCI with an accounting degree, and I just got hired on at Deloitte this summer, my education history would help fulfill my 2-year requirement. So that could help make sure I have that 2-year need met for my qualifying. Also we have situations where we see or we hear that, clients want to make a job change or whatever, and they think they have to stay on that job 6 months or anything like that. As long as I can show that I have an executed offer letter for my new job, I can potentially use that into my qualifying. I don't necessarily even have to be on the job a certain amount of time. I just have to show that 2 years of work and or educational history, okay? Now it gets a little bit trickier though when I have multiple jobs. So if let's say I work in the healthcare industry and I work at 2 different hospitals, one for 30 hours a week, another for 20 hours a week, I do have to show that I worked for both jobs for 2 years simultaneously. If I've had part-time work, I have to show 2 years job history. So that comes out often when we're meeting with clients. So there's just things to kind of think a little bit about. Now, if I'm applying by myself, so I'm just have a sole application, but I have a partner that earns income. If my partner is not going to join me on the application, then that income can't be included into the qualifying. It would just solely be off of my information. Okay. Another thing that comes up is, if I have W-2 employment, but I also, do Uber on the side, how do I count my Uber income? Well, we can potentially count that Uber income if I've been doing it for 2 years, but I have to be doing it 2 years simultaneously with my main W-2 employment. Okay, so that's kind of the key factor there. Okay, so let's continue to talk a little bit more about income, and I want to take you through a calculation that lenders will use to determine your qualifying. It's called debt to income ratio. And what it does, it takes into consideration your pre-tax income versus your monthly expenses. But those monthly expenses are only going to be inclusive of things like credit card debt, auto debt, personal loans, student loans. All of that gets factored into the debt to income ratio. And so other expenses that you may have, like maybe daycare expense or entertainment or travel expense, those don't get factored into debt to income ratio. it's just a measurement for qualifying. It's not necessarily for affordability. And so when we think about affordability and creating these plans for you as a future home buyer, we want to talk more about affordability. And that's a conversation that we have during a consultation. Debt to income ratio looks like this. So it takes into consideration the principal and the interest of my loan, plus the property taxes on this upcoming house that I'm considering, my homeowner's insurance, mortgage insurance if I have it, and then if there's a condo, maybe a townhouse. Some of our single family residences have this too, which is called a homeowners association dues. So if I have that all factored into a payment of $2,500 a month, and then as you can see on screen, if I have other debts of $500 a month, now I want to take that divided by my gross monthly income of $8,500 a month. My debt to income ratio is about 35.29%. Now, programs will allow that debt to income ratio to go as high as even 50%. Sometimes it's 45. Most first-time buyers feel pretty comfortable around 33 to 36% debt to income ratio. So it really just depends on every household. Again, it's our job to really kind of figure out what affordability looks like for you. Now, this qualifying is one thing, but affordability is really the most important aspect to designing a home buying plan for our clients. So the final stop along our journey towards homeownership in tonight's class is to talk about assets. So we've already reviewed a little bit about the market and budgeting and interest rates. You've learned about credit and programs and income. The last component to our home buyers plan is understanding assets. When I think about like a couple of the challenges that face first-time home buyers, it's really centered around two things. It's usually credit, because maybe we're a little overextended or we've had some challenges with our credit. More often it falls around down payment and assets, because a lot of our clients are just getting started off in their finances. They don't necessarily have a lot of savings because they're just starting to get off into their careers. So assets can be a big part of it. And we're going to talk about first-time buyer programs in just a second, but I want to kind of give you a sense of what we as lenders will be looking at from a documentation perspective when it comes to verifying assets. The minimum down payment is 3%. So we got to figure out how we get that plus our closing costs. Here's the documentation that generally we need. So checking and savings account statements for the last 60 days. Unfortunately, we can't use any type of cash. So everything all has to be paper trailed when it comes to home financing. Potentially, you can use 401ks, 403bs, even IRAs. I always encourage clients to talk to their financial advisors, maybe their tax advisors, about using those resources, because we don't want to create any type of tax challenges or miss out on opportunities in the market. And gift funds can come up as an opportunity for our buyers. And that's where a family member has helped kind of supporting us with home ownership by maybe gifting funds. They're going to help us with home ownership. So if I'm really running a little bit short with those funds that I need to purchase my home, a family member can hop in and help us with supporting us with funds. Now, those funds do not have to be seasoned in home ownership. If you get gift funds, they can be gifted to you right away. Other assets all have to be at least a seasoned 60 days. Okay. So when we look at home ownership, and like I said, one of the challenges is accruing or building enough savings. Assistance programs can really come in and help provide the void that's missing for a lot of our homeowners or future homeowners reaching home ownership. Many of you in tonight's class may think this is a 2 or 3 year goal, but guess what? It could be a 6 or 12 month goal, or maybe even sooner, utilizing first-time homebuyer assistance programs. We're proud to partner with CalHFA, which is the California Housing Finance Agency. We're the #1 lender with CalHFA, providing first-time buyer resources and support across the markets we serve. And so I want to share with you tonight a little bit about the CalHFA program suite. And then I'll give you a little bit of a glimpse of one of the products that's in construction right now or under construction. You may or may not have heard about it. So let's kind of dive in and talk a little bit about some of these programs. The first one is MyHome Assistance, which is one of the most popular programs with CalHFA. Provides up to 3% on a conventional loan for assistance to the down payment, 3.5% for an FHA loan. So really great resource there. So you think about our product learning that we had earlier tonight, that could cover the full down payment for your home purchase. The next product is ZIP Assistance. And ZIP Assistance is a closing cost assistance program, which is anywhere between 2 to 3% of your loan amount for a closing cost assistance. What this is, it's a 0% interest rate loan, does not need to be paid back until you either decide to sell the home or if you decide to refinance in the future. Let me take a step back for a bit and just talk about My Home really quick, because I want to just point out that that also is a loan. It's a 1% loan that's not paid back until you either sell the home or if you refinance in the future. The way CalHFA works is if you want to take advantage of these resources, you first would take advantage of My Home. And if you still need some additional resources, then we can add on the ZIP assistance as another tool in your tool belt for home ownership. Okay. I'm going to show you some examples in just a minute about what this could look like as we kind of provide some application to a few different home buying scenarios. The last one I want to talk about in CalHFA is the California Dream for All program. You may or may not have heard about this. You may be on the distribution list with us or with CalHFA. What California Dream for All program is, it's a shared appreciation program offered to the state. We rolled out kind of the 1.0 version earlier this year. CalHFA was able to help over 2,300 families achieve home ownership. That was a 20% assistance program. So ultimately it provided 20% of the sales price in assistance for home ownership. That was a no interest loan that the state provided. In exchange, you would also have a shared appreciation agreement with the state, where the state would participate in 20% of your equity growth over the time of ownership. Now, that program was such a big hit, the state allocated another $200 million to the program again to be refunded. That program is under construction. I'm actually fortunate enough to be a part of this project team to help develop the first product. We're going to help develop the second product, but that product is not going to be available probably till early 2024. And we'll have more details on that as that product rolls out. But in case you have heard about it, we want to make sure that you're aware that it is under construction. It's not going to be available probably this year, but stay tuned for more details. We're going to be hosting a live YouTube class tomorrow night. I'll be talking a little bit more about that and offering the details that we know of the program to date. Okay. And then, I want to kind of go back a little bit now and share with you some of those scenarios where if you were trying to incorporate the My Home Assistance or the ZIP Assistance program into your home buying plan, what that could look like. Because when we look at a home buying scenario, and I want to kind of draw your attention to this part of the slide here, if we were to buy a $700,000 house, we're going to need about 3% down payment, which is $21,000. And then we have to factor in closing costs. So when we think about closing costs, they're going to be loan origination fees, title and escrow fees, government charges, things like that. Those are generally 2 to 3% of your estimated sales price. So typically, if I was to buy a $700,000 house, I'm probably going to need $35,000 to $42,000 to buy my house. That may be attainable for some first-time buyers, but for most, it's not going to be. So that's where that assistance program can really help add that additional support. So now when we look at the other scenario, we can still buy that $700,000 house. The $21,000 down payment now would be offset by the support you get from the My Home Assistance program. And then we would only have closing costs out of pocket. So maybe that's $14,000 to $21,000 out of pocket instead of the bigger number of $35,000 to $42,000. The ZIP assistance could be another complement to that to help bring that out of pocket expense even lower. So, I think it's important to really understand that, it's not necessarily a situation where we have to save up for the next 3, 4, 5 years to be able to obtain home ownership. It could be one of those now goals, or at least a more of a shorter term goal when we leverage different assistance programs. So let's talk a little bit about eligibility on some of these programs, because I think that's an important component too, to understand that could be a fit for you. The credit score minimum is a 640 for an FHA loan, 680 for a conventional loan. The FHA product will provide 3.5% on the My Home Assistance. It's 3% for the conventional loan. The debt to income ratio that we just reviewed is anywhere between 45 to 50% maximum. Now, it's a little bit different in first-time buyer programs as opposed to, or CalHFA programs versus other first-time buyer programs, because the income calculation is not based upon a household size. There's a set income limit based upon the median income. So it's usually 120% of the median income in the market you're trying to buy in. And we only look at the applicant income, not the total household size income. So here's a good example. If I make, say, $150,000 a year and my spouse makes $100,000 a year, maybe combined we're over the income limits for CalHFA. But if I just apply in just my name and we can find a house or a purchase price that fits for us, then that is the income we use for qualifying purposes. And a first-time buyer, which is the eligibility for this, is someone that hasn't owned in the last 3 years, not someone that's never owned at all. So you may have sold your house in 2010, been renting ever since, and now you're going to be back on the market. You would still be considered a first-time buyer. And these are eligible for all types of programs, but it has to be a one-unit property. So new home construction is eligible, single-family homes, condos, townhouses, manufactured homes at times can work, but they have to be on land that is owned. And then here's what the income limits look like. They were recently just revamped. Every July, we go through a revision of the income limits based upon cost of living. So LA, Orange County, all those kind of came up. You may look at LA County and say, wow, that income limit's a little bit lower. Part of the challenge is LA is such a vast county that, you know, there's varying incomes across that county. Okay, so that's the CalHFA assistance product. Again, great resource for you as a first-time buyer. Now I want to kind of go into the buying process. Now, where do I go from here? So after I've been to tonight's class and maybe I want to kind of figure out what a home buying plan looks like for me, I want to take you through the 6 steps of home buying so you can better understand the workflow for owning a house. So this is our kind of our visual tool, 6 steps of home buying. The first step is going to be pre-approval. And pre-approval is going to be the output of when we have a video consultation with you. So generally the steps will, or the starting point will be submitting an online profile, uploading documents, and then we do a consultation. Well, the output of that consultation is your home buying plan, which includes your pre-approval, which that's good for about 60 days. We can always recertify your pre-approval at any time. So a lot of our clients may not be looking till the end of this year. We can always recertify. We don't have to have them reapply at all. Step 2 is going to be house hunting. So that's when you get a chance to go out in the market. Maybe it starts with an online search, but we really would encourage you to partner with a realtor, because eventually when you find a home that maybe you want to place an offer on, or at least go look at, that realtor will help kind of give you kind of all the ins and outs of the neighborhood, you know, potential pitfalls of that home, you know, the market data that will help you make a good financial decision. So that's step 2 is house hunting. Now, let's say I do my house hunting, I go out on Saturday, I find the house I love, and then I want to submit an offer on the property. Well, that realtor will help write up that offer for you. It's usually done all via e-signature. They'll submit the offer to the seller. If that seller accepts your offer, then we move to step 3, and that's called entering escrow. So that means I now have a contract with the seller to purchase their home. Now, the beginning of that contract is day 1. The process of actually finalizing ownership can be anywhere between as short as 17 to 21 days, could be as long as 60 to 90 days. But the rule of thumb in the industry is usually it's a 30-day process. Now, once you have an accepted offer, you're going to be getting a call from our team saying, congratulations, because that's a big deal, is just to get an accepted offer. Now, once we do that, we'll set us a follow-up consultation with you on the calendar for a video session to go over all of the financing for you. Make sure you feel comfortable with your closing costs, your payment breakdown, your out-of-pocket expense. All of that will be reviewed during your follow-up consultation. We also start the processing of the loan, which includes like ordering your appraisal, verifications of employment, all of those important things. Now, as a buyer, you're going to be expected in the first 2 to 3 days to make what we call an earnest money deposit. And that deposit is usually 1 to 2% of your sales price. Now, it's important to know that deposit is kind of like a good faith investment into the property. So it tells the seller that you have a financial stake in, you know, successful closing of this home purchase. Now, that money is generally protected by what we call it is the contingency period. And the contingency allows you as a buyer to do your homework on the property to make sure this is really a good fit. You know, do your inspections on the house. We'll get the house appraised as a lender to make sure the house is worth what you're buying it for, and we'll get your loan approved. And usually that happens in the first 10 to maybe 17 days of your contract period. So you're doing your due diligence. You're making sure this is a good financial decision for you and your family. And so as we go through that process, that deposit is completely protected. Now, during step 4 of the process, we're doing all kind of the back end work of your financing. Like I said, we're ordering verifications. We're maybe looking at some documentation, and we're getting everything prepared so we can send to the underwriting team who's going to render an underwriting decision. Now, prior to that stage, we're probably going to have your interest rate locked into your financing. So that's all secured. The interest rate lock has your interest rate protected during the processing of your loan. So if the markets change and interest rates skyrocket, you're locked in at that rate. So the underwriter issues your loan approval at step 4, and now we're in the approval stage at step 5. And it's almost like 3/4 of the way through the entire process. And at that time, we're also going to be at the end of our contingency period. So if we got our inspections back and they check off, okay, approval's good, appraisal's good, we can now tell our realtor that we're okay to remove our contingency. And what that tells the seller is that you've done all your homework, you're comfortable in your findings, and that you want to move to the final stages of the process. Now, as a lender, we're also going to issue to you a final closing disclosure, which is going to give you a 3-day cooling off period before we get to the final milestone, which is step 6 of closing the loan. And that's kind of the big day, because at the closing process, that's where we're going to be signing final documents in person with a public notary. That process usually takes 45 to 60 minutes, give or take, maybe sometimes as long as an hour and a half, depending on your type of product. On that day, you're also going to wire in your final amount of money that's owed out of pocket for your financing. So that's called cash to close. Usually that's going to be either wired over or sent via a cashier's check. Now that money will get reconciled by the escrow team. Once that's completed, we'll do one more final audit of your financing and then wire in the funds for your first mortgage. Maybe you elected the assistance program, we'll wire that in. That money gets all tallied up by the escrow team to ensure that as a buyer, you've contributed what you're supposed to, and the seller's receiving the proceeds that they expected. So once that's all kind of balanced out, then documents get recorded with the local county recorder's office. So let's say it's Orange County. Orange County will record documents for the transfer of grant deed, so transferring ownership. And then they'll record the deed of trust, which is the security for basically the loan, agreeing that you're going to pay back the loan. And once they get confirmation of that, that's when we get a chance to celebrate, because that's the big day. You get a chance to say, hey, guess what? I'm a homeowner. And that's probably the most enjoyable call I get a chance to make throughout my week, because we've gotten you to the finish line. Now we get a chance to celebrate. You're homeowners. You've made it through this process, and it's a huge thing. And we love to celebrate that with our home buyers. I mean, it's such an exciting day. I can't tell you how many great testimonials and pictures that I get via text from our clients celebrating, whether they have a sold sign or they're throwing up their keys in the air. It's a big day, and so we want to be there as a partner with you along the way too. Now, if that sounds like something you're interested in, of course, you're attending tonight's class because you're trying to just figure out home ownership. We love to get connected with you, and whether it's just kind of meeting up with you for an introductory call, which is like a 10 to 15 minute call, or maybe you want to kind of start going into a full consultation, which is about a 30-minute process. Leading up to that, you'll submit an online application, you'll upload some documents. We really try to make it a real seamless process. We try to leverage technology, and all of our sessions we do with our clients are all done via video. And by the way, this is a free service we provide. So whether you decide to buy this year or next year, or maybe this is just part of your 3-year, 5-year strategic plan, we want to help be a partner for you in designing a home buying plan. Here's what the consultation looks like. So it's looking at your application and deciding like, what's the right product fit for you? Where do you think you want to buy? Because that could impact the price of the home. What's the process going to look like for you? We'll do a credit deep dive review. We'll talk about assistance programs. And like I said, the output of a session during that consultation will hopefully be to have you pre-approved. I really like to do those over video because we do some screen sharing with you just to make sure you kind of really understand what the financing looks like and understand all your options available to you. Here's one of our resources I've mentioned a couple times tonight. It's our mobile app. It actually starts the application process right there. It's also a great tool for calculating payments, following the process of your loan. Really encourage you to download that for Apple or Android. I think it's a wonderful resource for you. And about our class and our partnership with UCI and the resources we provide to our communities. But we also have other alumni partnerships across the country. So whether you have friends, family, or coworkers that want to check out our classes, maybe they might be affiliated with some of these different partnerships. We pass along very similar discounts that we do for our UCI alums. So we'd love for those people in your network to check out some of our other partnerships. And as I wrap up tonight, I do want to include all of my contact information. So if you do have some follow-up questions after tonight, I know we have a couple in the chat right now that we're going to go through. But here's all my information. You can email me, text, call, whatever's good for you. And we really encourage you to follow us maybe on some of our social channels like Instagram. I think there's a lot of great things that we're putting out there. We've got a lot of good content, especially as it relates to first-time buyer resources and assistance programs. So we encourage you to follow us at JMade Mortgage to kind of learn a little bit more about that. So we appreciate you coming to tonight's class. I'm going to dive into some of our questions now, and then we'll spend as much time as we need to tonight answering our questions that come up, okay? So first question is there a maximum down payment for any of the loan assistance programs? So right now, there is no maximum that you put down. So whether you put down 10% or 50%, as long as you have the eligibility, you get the full assistance program. So whether that's the 3% MyHome or the 3.5% FHA assistance. Some of the niche products like California Dream for All, there's another product last year called Equity Builder. Those do have maximum out-of-pocket down payment caps, but the standard programs do not. Okay. Any other questions from our audience? And I've got us to the end here pretty quickly, so I think it's just getting a lot of questions. So question is, why do most people say to put at least 20% down? Great question. I think most of that is just because of just unknowns and maybe not understanding the dynamic of financing. I think the myth was, I got to put 20% down because I really want to avoid mortgage insurance, but not knowing that mortgage insurance is not necessarily as expensive as you might think. Now, I always encourage less financing. Like I want our clients to put as much down as possible, but 20% is not always available for most of our buyers. So when you look at financing options, putting less than 20% down is not necessarily a bad thing. On average, most of our clients are putting 3 to 5% down. So, but if you can do 20%, great, but it's not necessarily as penalizing as you might think when you have to go into a mortgage insurance situation. Okay, next question came in. Do you think rates will be going up or down in the months to come? I think that's a little bit of an unknown. My guess is we peaked in interest rates. I think we'll probably settle in the low 6s to high 5s for some time here, would be my guess, until inflation really gets under control and the Federal Reserve gets to a place where they're cutting rates. I don't think we're near that in the next 6 to 12 months, but I think we've at least seen the height of interest rates. And so now hopefully we'll just start to see things hopefully peel back a little bit. Will be interesting to see what the markets do tomorrow based upon Chairman Powell's commentary today. But, I think my sense is low 6s is probably what we have in the near future. Okay, so another question is, let me just read this really quick. So question was, if I've just paid off my paid off my auto loan and my credit score has changed since paying off my auto loan, is that going to be a negative factor to my score and or qualifying? So it's interesting. Some of your installment debt, if you do pay it off, there will be at times an initial decrease in your credit score, but it'll eventually recover. So we sometimes see that where a client has paid off an auto loan, they take a dip for 30 days, but then it kind of recovers. So that could happen. So we would have to kind of just see what else is driving there. You may want to get connected with us so we can kind of do a deeper dive in looking at your soft credit score to see maybe other things that are factored into that. All right, great questions tonight. Any other questions out there that I can help answer? Okay, I'll give it just a little more time. Okay. Okay, so another question that came in, I might need a little bit more information on this, but how does it work if you just, so the question is, maybe this audience member can kind of elaborate a little bit more. The question was, how does it work if you decide to sell before amortization? So maybe you can just give me a bit more on that question, and I'll answer that. And then a question was, are consultations also available in person? So we haven't really transitioned to in-person appointments as a business yet. Most of our stuff is done via video just for convenience factor for clients, but we can potentially figure something out if it's more suitable for you. We do have, obviously operations in the Orange County area. But generally most of it's done by video just for ease and convenience of our clients, and especially for commute situations. But again, the consultations are a free service that we provide to our clients. I mean, we want to help you on that path towards home ownership. You know, our approach is much different than other lenders where, you know, we're not here to try to sell you into home ownership. We want to be a value-added partner in home ownership for you. So, you know, whether that's this year or next year, you know, we want to help be that partner to build that plan for you. Okay, well, I think we've got all our questions out. And that question that I asked for the follow-up on, if you want to just, you know, email me or message me offline, that's great. I'll get that answered for you. But otherwise, I do appreciate everyone joining tonight's class. I know it's not easy to take time out on a busy Wednesday night, but hopefully this was well worth your time. We appreciate, you know, your involvement in tonight's class, and then we'd love to be able to connect with you either for an upcoming consultation or an introductory call. And hopefully we'll be talking to you all soon. Have a good night.